Soft Currency Economics by Warren Mosler. The U.S. Banking System. The gold system as the basis for bank reserves. The gold standard was established in the U.S. in 1834. Under a gold standard, the price of gold is set in terms of the dollar. The dollar was defined as 23.22 fine grams of gold, with 480 grains to the fine troy ounce. This was equivalent to $20.67 per ounce. The monetary authority was then committed to keep the mint price of gold fixed by being willing to buy or sell the gold in unlimited amounts. The gold standard was suspended from 1861 to 1879 due to the Civil War. The variant which prevailed in the U.S. from 1880 to 1914 was a fractional reserve gold coin standard. Under that standard, both government-issued notes and notes issued by commercial banks, also deposits, circulated alongside gold coins. These forms of currency were each convertible on demand into gold. Gold reserves were held by the issuers to maintain convertibility. In 1934, the Gold Reserve Act devalued the dollar by increasing the monetary price of gold from $20.67 to $35 an ounce. The act put the U.S. on a limited gold bullion standard, under which redemption in gold was restricted to dollars held by foreign central banks and licensed private users. As a domestic monetary standard, gold reserves regulated the domestic money supply. In a fractional reserve gold standard, the money supply was determined by the monetary gold stock, and the ratio of the monetary gold stock to the total money supply, which consisted of gold coins, fiduciary notes, and bank deposits. Money creation was determined by the amount of gold reserves. Bank deposits depended on 1. The level of gold reserves held by the commercial banks and the central bank, 2. The preferences of the public for gold coins relative to other forms of money, and 3. Legal gold reserve ratios. The primary action of gold as a basis for a monetary system is that its supply is limited, or at least increases slowly, whereas fiat money is limited only by the judgments of presumably fallible people. While the gold standard provided a stable monetary framework during much of its reign as the prevailing world monetary standard, the gold standard itself is not immune to problems of inflation and deflation. For example, an increase in the gold supply brought about by a major gold strike could increase prices and disrupt financial markets. Under gold standard rules and regulations, gold set the ultimate barrier to the expansion of bank reserves and the supply of Federal Reserve notes. Gold set the upper limit to liabilities of the Federal Reserve banks. For example, in 1963, the note and deposit liabilities of the Federal Reserve banks could not exceed 4 times their holdings of gold certificates, a special form of currency backed 100% by gold actually held in the Treasury vaults at Fort Knox, Kentucky. If the total Federal Reserve Bank liabilities were $50 billion, then at least $12.5 billion of the total would have to be in gold certificates. If the Fed were to reach the upper limit, the Fed would be unable to purchase any more government securities on balance or to increase loans to member banks. This would mean that bank reserves could no longer increase and would even have to shrink if the public wished to hold more currency. In case the upper limit in the money supply would have been reached. If a further increase in the money supply appeared desirable, the Fed had 2 options. First, the Federal Reserve could lower the bank's requirements so that with the same volume of reserves, banks could lend larger sums. Second, the Board of Governors of the Federal Reserve System could suspend the 25% gold certificate reserve requirement. The actual movement of gold into and out of the Treasury was a unique process because of the status of gold as a monetary standard. A description of the process of acquiring gold explains how gold certificates found their way into Federal Reserve banks. The term monetize means that the Treasury simply creates new money when they acquire gold. When the Treasury wished to purchase a gold brick from a gold mine, they printed a gold certificate. In the actual process of monetizing gold, the Treasury buys it from a gold mine. The gold bars are delivered to Fort Knox. The government pays by issuing a check. The gold mine deposits the check in its commercial bank. The commercial bank, in turn, sends the check to the Federal Reserve Bank for deposit to its reserve account there. The Reserve Bank then reduces the Treasury's balance by the amount of the check. The original outlay by the government has increased the gold mine's account without reducing any other private account in the commercial banking system, and the commercial bank has gained reserves while no other bank has lost reserves. In effect, the Treasury's balance at the federal bank has been shifted to a commercial bank. Both the money supply and the commercial bank reserves have been increased. Note that this type of government spending, which increases reserves and the money supply, is unique to the purchase of gold under a gold standard. When the government buys anything other than gold, they have to have, so to speak, money in the bank to pay for it. The money the government spends on missiles, cement, paper clips, or the president's salary has to be raised by taxation or by borrowing. The government, like everyone else, is prohibited from simply printing money to pay for the things it buys. If the government assigned other commodities the role held by gold, only then would the government acquire cement or paper clips by printing cement certificates or paper clip certificates. Everything else on which the government spends is covered by taxes or borrowing. Therefore, expenditures by the government from its account at the Fed are continuously offset by receipts of taxes or borrowed funds.